For over a decade, the technology sector has been the engine of global economic growth. Silicon Valley, with its sprawling campuses and innovative spirit, became synonymous with a new era of prosperity. Companies like Apple, Amazon, and Google achieved valuations exceeding the GDP of entire nations. Their products and services woven into the fabric of everyday life. The stock market reflected this exuberance, with tech stocks soaring to unprecedented heights. Investors, both seasoned and novice, poured their savings into the market, eager to capitalize on the seemingly limitless potential of the digital revolution. From artificial intelligence to cloud computing, the future appeared boundlessly bright, fueled by the relentless pace of technological advancement. The rise of tech stocks wasn't confined to Silicon Valley. Across the globe, from the bustling tech hubs of Shenzhen to Bangalore, a new generation of entrepreneurs and innovators emerged, riding the wave of technological disruption. Venture capitalists, flush with cash, funded startups at an unprecedented rate, betting on the next unicorn to emerge from the digital ether. The world had entered a new gilded age, and technology was its gold. The first tremors of the impending storm were subtle, easy to dismiss amidst the general euphoria. Inflation, dormant for years, began to stir, driven by the massive influx of capital into the tech sector. The Federal Reserve began to raise interest rates, signaling an end to the era of cheap money. The tech sector, heavily reliant on debt financing, began to feel the pinch. Geopolitical tensions and supply chain disruptions added to the uncertainty. The summer of 2024 marked a turning point. The NASDAQ, the stock market index heavily weighted towards technology companies, experienced a sharp decline, wiping out trillions of dollars in market value. Suddenly, the seemingly invincible tech giants looked vulnerable. Apple, Amazon, and Microsoft, the darlings of Wall Street, saw their stock prices plummet. The era of easy gains was over. The mood in Silicon Valley and other tech hubs shifted from one of boundless optimism to cautious apprehension. Layoffs, once rare in the tech industry, became increasingly common as companies sought to cut costs and adjust to the new economic reality. The once lavish perks and benefits that had become synonymous with tech culture were scaled back. The party, it seemed, was over. The question on everyone's mind was simple yet profound. Was this a temporary correction, a healthy pause after years of exuberance, or the bursting of a tech bubble with far-reaching consequences for the global economy? The answer, as is often the case in complex systems, was anything but straightforward. The tech world found itself on edge, bracing for the storm ahead. The NASDAQ 100, a bellwether for the tech industry, had been on a tear for years. From its pandemic lows in March 2020 to its peak in July 2024, the NASDAQ 100 had more than doubled. However, the summer of 2024 saw the NASDAQ plummet, shedding trillions in market capitalization. The speed and ferocity of the decline caught many investors off guard. The reasons were multifaceted: inflation, rising interest rates, and geopolitical uncertainties. The NASDAQ's decline was a stark reminder that even the most seemingly unstoppable bull markets are not immune to economic forces. Section 2, The Anatomy of a Downturn, Unraveling the Factors. To understand the tech downturn, one must dissect the interplay of factors. It was a perfect storm of economic headwinds, geopolitical tensions, and reassessment of growth prospects. Inflation played a pivotal role. Loose monetary policy and government stimulus sowed the seeds of inflation. Demand surged, but supply chains couldn't keep pace. Prices surged, eroding purchasing power and forcing rate hikes. Rate hikes had a ripple effect, especially in the tech sector. Tech companies faced rising borrowing costs. Financing operations and growth became more expensive. The days of easy money were over. Geopolitical uncertainties added to the tech sector's woes. The war in Ukraine and US-China tensions created instability. Supply chains became further strained, leading to shortages. The tech industry, reliant on global supply chains, was caught in the crosshairs. Tech titans navigate the storm. The tech downturn hit even the biggest names. Apple, Amazon and Microsoft all saw significant declines. Apple's stock tumbled despite strong fundamentals. Amazon faced slowing growth in e-commerce. AWS growth also slowed. Microsoft weathered the storm but still declined. Azure provided some buffer, but other segments struggled. Section 1. Whispers on Wall Street, a crisis of confidence. The tech downturn sent shockwaves through Wall Street, shaking the confidence of even the most seasoned investors. The once unthinkable, a significant correction in the tech sector, had become a reality. The consensus that had once underpinned the tech sector's rise had evaporated, replaced by uncertainty and doubt. Even the wisest market participants were becoming wary of the tech sector's lofty valuations. Investors seek shelter from the storm. Investors, both institutional and individual, headed for the exits. The market for tech stocks transformed into a chaotic scramble for liquidity. Sell orders flooded the market, driving prices down further. The flight to safety was on. Investors sought refuge in less risky assets. Bonds, particularly US Treasuries, saw a surge in demand. Gold also benefited, its price rising as investors sought to preserve capital. Opportunities amidst the chaos. Amidst fear on Wall Street, contrarian voices saw the tech downturn as a chance for long-term gains. They believed in the tech sector's enduring growth drivers like digitalization and AI. The downturn was seen as a temporary correction, not a rejection of tech's potential. Silicon Valley reels. The epicenter of the storm. Silicon Valley, the heart of the tech industry, bore the brunt of the downturn. Once a symbol of boundless optimism, the valley faced layoffs, slashed valuations and uncertainty. The streets, once bustling with tech workers, seemed quieter. Layoffs became common as companies cut costs. Startups made difficult decisions, letting go of talented employees. The competition for tech talent eased, replaced by shared vulnerability. The impact extended beyond the tech workforce. The Bay Area experienced a slowdown in its real estate market. Home prices began to decline as demand waned. The ripple effects were felt throughout the regional economy. The mood in Silicon Valley had shifted. The tech industry, once at the forefront of innovation, found itself on the defensive. The era of easy money and unbridled growth was over. A new era of caution, financial discipline, and focus on profitability was dawning. The tech sector, accustomed to breakneck growth, faced a new reality of slowing growth, contracting margins, and increased scrutiny. Profitability became paramount. E-commerce growth moderated as consumers became more discerning. Cloud computing growth slowed as businesses optimized spending. Rising input costs squeezed margins. Companies had to become more efficient and focused on delivering value. The tech downturn highlighted a growing divergence in the stock market. The NASDAQ experienced a sharp correction, while the Dow Jones proved more resilient. This reflected tech's high valuations and sensitivity to interest rate hikes. Value stocks in sectors like energy and financials outperformed. The tech downturn reminded investors that not all market sectors move in sync. The relentless pursuit of innovation defines the tech industry. Companies invested heavily in R&D during the tech boom. Areas like AI, cloud computing, and autonomous vehicles saw significant investment. Rising R&D costs pressured profit margins. Developing cutting-edge technologies requires massive datasets and skilled workers. The competition for talent further drove up R&D costs. The tech sector faces a margin squeeze as rising costs collide with slowing revenue growth. Rising labor costs are a significant factor. Supply chain disruptions have increased costs for raw materials and components. The rising cost of energy adds to the burden. Slowing global economic growth pressures tech revenues. Companies must compete more aggressively on price, eroding profit margins. AI is the most transformative technology of our time. AI offers opportunities to automate tasks and improve decision-making. Tech companies invest heavily in AI R&D. AI promises economic benefits but also raises ethical concerns. Job displacement and bias in AI systems are significant issues. The tech industry must develop AI responsibly. Balancing AI's promise with its pitfalls is crucial. NVIDIA's rise from a niche player to a tech titan is remarkable. NVIDIA's GPUs power everything from gaming rigs to AI algorithms. The gaming industry's growth propelled NVIDIA's success. NVIDIA invested heavily in R&D, pushing GPU technology boundaries. NVIDIA recognized GPU's potential for AI and pivoted strategically. NVIDIA's GPUs became the go-to choice for AI workloads. NVIDIA positioned itself at the heart of the AI revolution. NVIDIA's success propelled its stock price to dizzying heights. Investors bid up NVIDIA's stock price, reflecting future growth potential. NVIDIA's valuation reached a staggering $1 trillion. Some investors questioned whether NVIDIA's fundamentals justified its valuation. Concerns about competition and technological disruption gained traction. NVIDIA's high valuation became a potential bubble waiting to burst. NVIDIA's reign as a market darling ended abruptly. The slowdown in the gaming market hit NVIDIA's revenue hard. The data center market showed signs of slowing. Increased competition from AMD and Intel pressured NVIDIA's revenue growth. Investors questioned the sustainability of NVIDIA's high valuation. NVIDIA's stock price corrected sharply. The software sector's valuations plummeted in the tech downturn. Cloud-based software companies enjoyed unprecedented prosperity during the boom. The shift to cloud computing fueled the software sector's rise. Investors demanded greater scrutiny of valuations and profitability. The era of easy money and unbridled optimism ended. Software stock prices declined swiftly and widely. The once reliable growth engines of the tech sector faced uncertainty. The software sector's struggles reflect a changing landscape with slowing growth, intensifying competition, and increasing pressure on profit margins. These factors, combined with macroeconomic headwinds, create a perfect storm for software companies. One significant challenge is slowing growth. The market shows signs of maturity after years of rapid expansion. Companies now face a more competitive landscape. They must fight harder for new customers and retain existing ones. Competition intensifies with new entrants and market expansions. Cloud computing is now a crowded battleground. Tech giants vie for dominance, increasing pressure on pricing. Rising talent costs further pressure profit margins. Smaller companies must be creative in talent acquisition. The rise of artificial intelligence, AI, has cast a long shadow over the software industry, both as a potential boon and an existential threat. On the one hand, AI has the potential to revolutionize software development, automating tasks, improving efficiency, and enabling the creation of entirely new categories of software applications. Software companies that embrace AI and integrate it into their products and operations stand to gain a significant competitive advantage. On the other hand, AI also poses a potential threat to the traditional software industry. As AI systems become more sophisticated, they are increasingly capable of performing tasks that were once the exclusive domain of human software developers. This raises the specter of job displacement within the software industry. as well as the possibility that AI could eventually render some software companies obsolete. The software industry is at a crossroads, facing a future where AI will play an increasingly prominent role. Software companies that can harness the power of AI, integrate it into their offerings, and adapt their business models to this new reality will be well positioned for success. Those that fail to adapt risk being left behind, their once valuable software products and services rendered obsolete by the relentless march of technological progress. The software sector's future is inextricably linked to the evolution of AI. The tech sector is caught in a tempest, buffeted by economic headwinds and geopolitical tensions. The once predictable waters of the digital economy have turned choppy, forcing tech companies and investors to navigate uncharted territory. Amidst the storm clouds, there are glimmers of hope for those who can adapt and innovate. Predicting the future in technology is challenging, but analyzing trends can help. The current downturn is likely a period of transition, paving the way for a more resilient tech industry. One key trend is the increasing convergence of different technological fields. AI, cloud computing, and IoT are creating powerful synergies and unlocking new possibilities. Data privacy and security are growing in importance. Companies prioritizing data privacy will build trust and gain a competitive advantage. Beyond the bubble, the enduring power of innovation. The tech sector's recent downturn should not overshadow the enduring power of innovation. The tech industry disrupts the status quo, creates new markets, and improves our lives. This spirit of innovation remains alive and well. The current downturn is an opportunity for a reset, a chance to refocus on innovation, creativity, and progress. Companies that embrace this opportunity will emerge stronger, willing to challenge conventional wisdom and learn from mistakes. Innovation will flourish in artificial intelligence. AI can revolutionize industries like healthcare, finance, and manufacturing. Tech companies are developing groundbreaking AI applications. The race to unlock AI's potential is just beginning. Another area ripe for innovation is the metaverse. The metaverse holds immense potential for social interaction, entertainment, and commerce. Tech companies are investing heavily in the metaverse, creating a new frontier for innovation. Section 3, the adaptive enterprise thriving in the age of disruption. The tech sector's recent downturn is a stark reminder that we live in an age of constant disruption. The pace of technological change is accelerating, global competition is intensifying, and macroeconomic uncertainty is the new normal. In this environment, the ability to adapt is no longer a nice-to-have, but an imperative for survival. The tech companies that thrive will embrace agility, flexibility, and a willingness to challenge their own assumptions. They will be data-driven, customer-centric, and constantly experimenting with new ideas. They will foster a culture of innovation where failure is seen as a learning opportunity. One key aspect of adaptability is the ability to attract, retain, and develop top talent. In the tech industry, people are the most valuable asset. Companies that invest in their employees will have a competitive advantage. Another important aspect of adaptability is the ability to embrace partnerships. In today's interconnected world, no single company can be an island. Tech companies that are open to collaborating will innovate more quickly and create more value. The future of the tech industry is about building a more collaborative ecosystem. The tech sector is at a crossroads, facing both challenges and opportunities. The companies that embrace adaptability and foster innovation will thrive in the years to come. The tech cycle, boom, bust, and renewal. The recent turmoil in the tech sector is not an anomaly. Technological innovation follows a cyclical pattern: growth, correction, and consolidation. This cycle is driven by human ingenuity, market forces, and uncertainty. The dot-com bubble of the late 1990s is a prime example. The current downturn is a necessary correction for a more resilient industry. It will create opportunities for new innovators to reshape the tech landscape. Learn from past mistakes, focus on strong fundamentals and sustainable models. The tech cycle is not a reason to fear innovation. Setbacks are inevitable, but opportunities arise from disruption. The tech industry adapts, reinvents, and emerges stronger from adversity. The current downturn is another chapter in the ongoing story of growth and change. Section 2. A time for prudence, a time for opportunity. The current tech downturn presents both challenges and opportunities for investors. It is a time for prudence, for carefully scrutinizing valuations and assessing risk. The days of blindly investing in any tech company with a compelling story are over. Investors with a disciplined, long-term perspective are more likely to weather the storm. The downturn also creates opportunities to acquire high-quality companies at discounted prices. Fear and uncertainty drive stock prices down further than warranted. Value investors can acquire shares of companies with strong long-term growth potential at bargain prices. The key is to identify companies with the financial strength to weather the storm. The tech sector is volatile but has immense potential for growth and innovation. Investors who can stomach the volatility and invest with a long-term perspective have the opportunity to be richly rewarded. Section 3. The future of tech navigating uncharted waters. The tech sector is sailing into uncharted waters. The forces shaping the future of technology are complex and constantly evolving. By embracing continuous learning and adaptation, we can harness technology to create a better future. The pace of technological change is accelerating. Emerging technologies like AI and blockchain are still developing. These technologies can revolutionize industries and transform societies. Tech companies must be agile, adaptable, and innovative. Embrace diversity, collaboration, and responsible innovation. Navigate uncharted waters to create a sustainable, equitable, and prosperous future.